It's Wednesday. Let's chat. Hi, I'm Kanan Chandran, the publisher of stormasia.com, and this is the Wednesday web chat, the WED web chat, where we talk about all kinds of things. We bring up issues that are current, which are topical, and which people may want to find out more about. So, as always, we have an opportunity for the audience in these discussions to ask questions. So there is a Q&A box and a chat box open. So if you have questions on today's topic, which is about alternative investments, put them in there and we'll try and address them, because we've got a couple of panelists today who are well versed in this area. They've written a book about it. So why shouldn't we ask them more questions? But let's look at this space of alternative investments. I had a friend who, way back, was interested in investing, but didn't quite have the funds and couldn't qualify for a lot of things that were needed. It didn't have the required amounts of money and track record, etc. So he thought, well, if I can't do all of those, let me look at other things to put my money in. So he invested in a few cat houses in Vietnam, and it made him a fair bit of money. So it's about the mindset. It's about the willingness to think differently and do stuff in a very different way. And so today's session, we have Matthew Dearth, who's the Managing Director of Silvercrest Asset Management. It's an independent advisory and financial services firm, and he's been 30 years in this business. Since 2016, he has been the adjunct faculty in finance at the Chian School of Business at the Singapore Management University. Joining us is almost a regular at these series, Swee Yong, who's the Director of International Property Advisor, who has authored 6 books on the real estate market. And this is his first collaboration with Matthew. The book they've written is Getting Started in Alternative Investments. I think it's going to be good fun because this whole area, Matthew and Swee Yong, people tend to look at the traditional stuff, and then suddenly this is alternative investments, which just sort of, it's not new, I gather, but there are new things being added to it, which makes it a lot more spicy and exciting. So the key areas in alternative investments is private debt, the hedge funds, private equity, real estate, structured products, commodities, and the one that I think is quite interesting is collectibles, right? So maybe if we could start with each of you just talking a bit about yourselves and talking about why you think this book had to be written. Let's start with you, Matthew.
Sure, thank you. So my background, I've been in finance in various roles for about 30 years. Worked at a big hedge fund for a while, worked at a big investment bank for a while, moved here to Singapore 8 years ago, and immediately in my course of settling down was introduced to somebody who was a faculty member at SMU. And he knew of the hedge fund that I used to work for and said, oh, why don't you come in and talk to my class about the strategy? And I did. And then 6 months later, he called me and said, hey, I'm going back into industry. Do you want to teach my class? Now, that's not the way they fill positions anymore, but 7 years ago, it worked out that way. And so I've been teaching graduate courses at SMU for 7 years now. And they've always been on investing and alternative investments, and most recently on sustainable finance. The classic curriculum there is, as you said, it's very heavy in the more traditional investing. It could be stocks and bonds, which literally is the traditional part. And then you get into venture capital, private equity, hedge funds, things like that, real estate. And yet there's this whole other world of fascinating investment opportunities. And so I've made a conscious effort to include that material in my classes. And Swee Yong and I taught together for several years. And in the course of that, we realized there's no book for this. So, hey, why don't we actually write a book that can help, whether it's our students or just members of the general public that are interested in learning about other ways to invest than the traditional stuff that they might be familiar with.
After teaching this module with Matthew, that I have never written about how real estate investment should be done. My previous books are all about what's happening in the market and where I see the market going, what investors should be mindful about. But I've never actually gone to the basics, the foundations of what is actually an office building versus a residential versus an industrial. And so those were the things that we taught in class that, look, let's start from the foundation. You define an office building. This is the demand for an office building. Industrial has a different demand. What indicators from the market do you read? And I tried to write it or teach the course in a way that I learned the subject myself. My first degree was in chemistry. So I thought that it is picking up real estate. I didn't learn it from school. I wanted to teach it how I picked it up from industry while working in real estate. So that was how I wrote and how I taught the class, and my slides all speak the same way. But then, of course, after getting together with Matthew, I also realized that I think in this turbulent world, if you just wanted to stick with the sort of traditional lazy stuff, like just buy a stock on the stock exchange or buy a bond and 5 years later the bond matures and then you take back your money, the lazy way of investment is not the way forward. I think we should get into working harder to make our money work for us. It's no more fire and forget from here on. That's why alternative investments are going to grow in importance in everybody's portfolios.
Okay, it's on, from what I've read, the reallocation of capital into alternative strategies is shifting. It's more, it's growing in interest. It's moving towards like a 50, 30, 20 mix of stocks, bonds, and alternatives. I don't know if you share that sort of thinking as well. But the interest in alternatives, it's more open in that more people can participate in this space. Does it also mean that there are more risks, or are there less risks? I mean, how should you approach this if you are venturing into this alternative investment space?
Yeah, no, it's a great question. First of all, if I start with your observation, I think it is absolutely fair to say that the allocation to alternatives is growing. Whether you're talking about institutional investors, these can be everything from GIC here in Singapore to your insurance company, the SMU and endowment, anything like that, all the way to individuals, and we're talking high net worth to the person on the street. And at the same time, there are different protections that we're used to as investors when we talk about listed stocks, when we talk about mutual funds, kind of the traditional way of thinking about stocks, bonds, what we grew up thinking were investments. There are regulations that protect investors as much as anything can for those sorts of instruments. Alternatives are not regulated the same way, and in many cases, they're just not regulated. And so with that very light amount of oversight on a relative basis, investors need to be very, very careful. And we can look at all sorts of different examples, and we mentioned a number of them in the book. You've got, if you go back 20 years, or 15 years, you've got Bernie Madoff, and he was running a big successful hedge fund. And then you've got FTX and everything that's gone on in crypto in the last 5 years in particular, so many frauds and things like that. So yeah, you need to be careful. I agree with Swee Yong that this is where I think people have an opportunity to make their money work harder for them. But you can't fool yourself. There's a lot of risk out there.
Is it a cowboy town out there in terms of alternative investments?
It depends, in my view, and Swee Yong, you have forgotten more about real estate than I'll ever know, but certainly with respect to some of the other alternatives that we talk about in the book, I think I think cowboy is probably a little bit strong in some markets, but if you look at crypto, whatever's like, it's cowboys riding a T-Rex with a handful of bare knives. I mean, it's like, how much spice do you want? It's kind of like crazy risky, as we've seen. And so, depending on which piece you're talking about, there can be more or less risk.
Yes, but that's crypto is considered a very new thing in the market. I've got friends and relatives 20 years ago who have gone into prawn and fish farming businesses. You go evaluate them, you visit the farm, and you have to keep going back there in case the farmer that is your joint venture partner is sleeping on his job, right? So those who are active in this farming business, they have actually done well, and they continue to be in farming investments throughout these last 20 years. Those who were lazy with just believing in the promises that I buy this ostrich in Australia, and then the eggs from the ostrich would keep me filled with recurring income. Those guys, of course, lost their money.
Okay, there is risk in everything, I guess. And
of course,
just very quickly, there was a question that popped up so that we can put things in context. What are the alternative investments? I think maybe it might be good to just, if both of you could just share your views on how you would define it. Swee Yong, maybe start with you.
So for me, alternatives are real estate as a main product, as a main asset class that I'm looking at, because that's what the finance textbooks would say is not a mainstream investment. But even within the real estate part of things, I am looking at, for example, I'm paying attention now to the land that is being sold in the metaverse. I'm also paying attention to what are the new technologies that are in real estate that might make real estate morph. For example, our Zoom now is sort of impacting the demand for office real estate. And so I'm looking at some of these changes. And of course, as the developed nations grow older, I think we do need a lot more senior care homes as well as healthcare facilities. So I'm just paying attention to what's going on there.
Okay, yeah, I suppose there are a lot of issues that will also shape the way you view the alternative investment environment, right? Okay, Matthew, what's your definition?
I'll zoom up. I'll give you first the academic answer. An alternative investment is something that is not stocks, bonds, or cash. All right, so everything else is considered an alternative, right? So people say alternative to what? Alternative to stocks, bonds, and cash. Then we've got the traditional alternatives. And for those, it's actually a lot of the things, Kanan, that you mentioned. So real estate, certainly, commodities, so precious metals in particular. I think a lot of people are experienced with that. But we also have venture capital, hedge funds, private equity, private debt, perhaps. These are, and I think structured products, if I didn't mention those before, these are kind of more traditional types of alternatives. Then we get the fun stuff. And so, looking at buying, virtual land in the metaverse is a great example of how kind of off the run we can be. Maybe I'll just kind of quickly read through. This is some of the stuff that we talk about in the book, right? So private credit and alternative finance, this can be things like doing very small loans to SMEs through a platform like, FundNel or Crowdo here in Singapore. It could be insurance-related finance. So that can take the form of catastrophe bonds, which are issued by insurance companies to basically help them out if there's like a big natural disaster and impacts their portfolio of insureds. It can also be what's called life settlement funds, where you go to somebody that's getting on in age, 80 years old, they have a large life insurance policy, and you say, I'll buy it for you or from you for, if it's $1 million policy, I'll pay you $600,000 now. Then I'll keep paying your premium payments until you die, but then I get the death benefit when you die, right? So very wild kinds of opportunities there. Impact investing is kind of a more social-minded type of alternative investment where you're really trying to make a difference in people's lives or the environment. There's some great examples here in Singapore. IIX is one. They've actually created listed bonds that are tied to impact investments. Obviously, in the world of digital assets, we've got coins, tokens, metaverse type stuff. There's of course the infamy of NFTs and Bored Apes and all digital rocks and all this other kind of stuff. And then we can get into collectibles and pretty much anything we can think of if it has scarcity and people associate it with some kind of personal emotion or it represents a level of craftsmanship or things like that. It can be art, it can be ancient Chinese porcelains, and it can be sneakers and streetwear. The latest Supreme drop or collab with Louis Vuitton. Those create investable things. And it keeps going from there. But yeah, it's a wide world and lots of different things that you can dig into. I didn't even mention, we've got like wine, whiskey. Some of those of us here as your panelists probably enjoy some of those. Swee Yong and I do. Classic cars, watches, yeah, tons of stuff.
Yeah, so it's a wide array, right? So, but something like catastrophe bonds, right? How does it work? I mean, how do you benefit? Maybe if you could just talk us through very quickly how something like that comes about and how it works.
Got it. So a catastrophe bond is a really fascinating instrument. So most people don't know this, or I didn't until I started working in the insurance industry a long time ago. Insurance companies also need insurance, right? So they don't have enough capital themselves to kind of like self-insure if there's a disaster because they're counting on diversification of risks, right? So an insurance company that only insures properties in Western Europe is then susceptible to a disaster if they're like big wildfires or the floods or whatever might be an earthquake. It's not a big earthquake zone. Here we have typhoons, etc. So the insurance industry started issuing bonds, and these bonds would be generally in the shorter duration, 3 to 5 years. And the payment on the bond is conditional on what happens from an insurance perspective during the life of the bond. So if you issue a bond for, let's say, you're going to cover, typhoon risk in the Philippines and Indonesia. So you would define certain parameters of typhoons that would act as a trigger. And so if a storm that was severe enough or matched the characteristics of the trigger that you developed when you issued the bond, you said, this is my trigger. If there's essentially a covered event, then the insurance company will take some of the principal amount from that bond and use it to cover its losses. So as an investor in catastrophe bonds, you're basically taking a view on weather risk. It could be, typhoons, it could be of volcanic activity, it can be earthquakes, can be fires, can be floods. And the neat thing is that if you're thinking about your portfolio, most of what we start with in stocks and bonds is basically highly correlated to what happens to the market overall. Even if you're buying an individual stock, right? You're taking a lot of stock market risk, but the weather is not correlated to the stock market, right? So it diversifies your risk. The problem is that you also have to be able to say, well, how well do I understand weather risk? And most of us don't. So depending, that one in particular, as individuals, we really wouldn't go out and buy a catastrophe bond, but we'd look for funds. They tend to be available more through bank networks and private banks, but there are some firms that make these catastrophe bonds available in a mutual fund form, and I find them fascinating for their lack of correlation. Now, the last thing I'll say there is now we're in this climate change world, And actually, the results from cat bonds over the past 5 years have been really materially worse than they had been for the 15 years before that. So we've got to ask ourselves the question, like, is the weather changing so much that in fact the industry has not figured out how to price that in a way that we should feel comfortable investing in these kinds of instruments?
So what are you actually investing in, that there is no catastrophe or that there is a catastrophe?
That there is no catastrophe.
Okay. And if
Or
a
if there is,
catastrophe takes
or if
place,
there is, if it's too small, right? So
it doesn't
imagine,
fall into that
yeah,
area. So,
right.
so in a way, it's a bit of a social investment tool as well, right? Because if something happens and you need to help out these people, your money is going towards that. Could that be a
You
perspective on
know,
this?
it's interesting. So when I teach sustainable finance, sometimes we have this discussion. It's not actually as socially oriented as you would think, because all you're doing is helping the insurance company, right? This is providing insurance for the insurance company. So to the extent that the insurance company could go bankrupt in the event of a large catastrophe, then yeah, I mean, I suppose you are providing some sort of social benefit. But otherwise, what you're really doing is just helping the insurance company manage its own risk profile. And so they're just choosing, because there's insurance for insurance companies called reinsurance. So they could either get traditional reinsurance or they could issue a catastrophe bond. Neither one of those is directly aligned with kind of pure social objectives.
Okay. So there is a commercial element to it as well.
Absolutely.
Okay. I mean, that's what this is all about, right? It's about making money at the end of the day, no matter how you couch it.
Unless you're talking about impact investing. Impact investing is really about trying to make a difference either on an environmental side or a social side, but that's a different one.
But with impact investing, there's also this fact that as a large organization, you also want to be seen to be doing good, because it also helps you in a non-pecuniary manner, right? Put money into things, you're seen to be doing the right things. Your stock goes up because of their perceived or their perception.
Yes.
Right?
That's kind of, we call that greenwashing or impact washing or social washing, all the washings. But I think that really the message with impact investing is look for the smaller firms that have a real track record and can tell a real story about not only how do they identify the investments that they're going to make, so they generally choose a theme. So like IIX has had, for example, their women's livelihood bonds here in issued through DBS here in Singapore, and those are really trying to fund small women-led enterprises throughout ASEAN. They measure the impact very, very carefully. So, what did our investment actually achieve? And that's one of the characteristics that often is missing with larger organizations trying to kind of direct a little bit of capital towards a feel-good project. So again, back to your point, as an individual investor, you need to do your homework to really make sure that you're going to get what you're actually looking for.
I just want to, you raised this, and I'm wondering, do you need to have a different sort of head screwed on when you want to get into this alternative investment space, as opposed to your traditional, right, your stocks, your bonds, your cash sort of thing? Can somebody who's in the traditional space just switch over to alternative readily, or you need to have a different sort of thinking?
I'll give my answer, and then Swee Yong, you can chime in, because I see you're liking this question. Look, I think that we grow up thinking that investing in the stock market, or in bonds is what we should be doing. We might follow the market. We have friends who talk about stocks or bonds. Or you're going to buy this bond, you're going to do that. We're used to that. And again, that means we're used to operating with the set of protections that regulators provide. They're not foolproof, right? You just look at bankruptcies that happen and things like that, failed banks recently. But in the world of alternatives, you don't have that. So I think you naturally need to dial up your skeptical meter to a higher level. You need to be a little bit more cynical, question more, be a little bit more skeptical, because there are risks that you probably have not been taking before that you now will be taking, and you can't do things the way you were doing before. Now, does that mean that you can't make that switch? All I've ever done is buy index funds and things like that, and now I want to look at alternatives? No, you absolutely can. You just have to kind of set your dials differently. I don't know, Swee Yong, what do you think?
I think we just have to be a lot more willing to work hard and willing to push our money to work hard, and then recognize that even if you wanted to get into something that you are passionate about, could be whiskey and wines, it could be watches, it could be luxury branded collectibles where this is there are only 10 pieces of this handbag in the world. You have to do the homework. You have got to know what's the competition. This person who produced this item, is he going to lie about it or not? And then when it comes to investing in social good, you have got to expect that your investment is not going to pay you back money in the next 2 to 3 years. You've got to allow it to grow. And because of the additional work that has got to be put in, expect that the fund manager also would have to deploy a team of people on the ground to measure the results, and not just write a beautiful report to you with a PR agency, but that they actually employ people who understand the environment, understands climate, understands the science behind some of these ESG sustainability investment projects. So a lot more homework, but the payback could be 10x, but it could be stretched out to 15 years, not something in the stock market that is going to return you 5% a year.
Well, if that's the case, then if you were to weigh up between the two, why would you choose one over the other?
The two being what? Traditional,
One's the
traditional stuff
and then the alternative, yeah.
So the real argument in favor of investing in alternatives is actually what we would call diversification, right? So, from an academic standpoint, you are getting into the world of kind of looking at how you create optimal portfolios that will deliver good returns for you over a longer period of time for a given amount of risk. So when you diversify, you can lower your risk because assets move in different directions. Stocks go down, something else goes up, or something goes down less, right? Traditionally we thought that the old 60-40 portfolio of 60% stocks, 40% bonds was going to provide that cushion. This is, 22 and into this year was like the first time in the last 40 plus years where that hasn't worked. And it's worked very well for most of our lifetimes. But when you start adding in these different alternative investments, you really have a chance to diversify your performance and diversify your risks, and that over longer periods of time. This is not quick buck kind of thinking per se. There are some things you can do that are just kind of trying to get some quick wins. But just in general, if you think about your financial future over a longer time horizon, the diversification benefit you get from alternatives can be quite powerful.
So even in real estate, we have got the giant-sized real estate funds that diversify their investment holdings within the real estate world. So they would have some of their money in debt, which is real estate mortgages. They will have some of their money in real estate that is under construction. They could have some of it in raw land, and they're just doing land banking, waiting for it to be developed. And of course, they will have a large chunk of holdings that are in income producing real estate, things that have already stabilized and are generating income for them. Because if you don't diversify even within the real estate segment, look, right now, the higher interest rates all of a sudden is killing quite a few US and European developers. The shares have tanked. But if you are in real estate debt, at the same time, you are able to increase your interest for real estate that is newly issued out. So within real estate world, you need diversification too.
Yeah. Okay. So Matthew, you said that it worked. The 60-40 worked well for 40 years or so. Now we're on the cusp of change, or well, we are in the thick of change already. And as a result, that hasn't worked so well. So alternatives have come in. Is it changing the shape of investment and investing on a more permanent basis? Is that 60-40 thing going to be out the window? And we're now looking at a 50-30-20, which could become a 40-30-30, or what? How do you see it?
Yeah, I think it really depends on which kind of investor you're talking about. I think if we go back to the mid to late 80s, there was already a wave in the more sophisticated institutional market towards getting more of the assets out of the traditional and into this traditional alternatives, especially venture capital, real estate, private equity, and to a certain extent hedge funds. For individuals, that's a little harder because oftentimes those types of vehicles have pretty high minimums, right? So it's harder to get in exposure to those. I think where we are now, with a lot of us as individuals having built our portfolios around an idea of the bond portion giving us more benefit than we got this last 12 to 18 months, I think a lot of people are really starting to question that allocation. So I think you're entirely right that something like a 50-30-20 or whatever it might be, where you take 20% of your portfolio and look for other alternatives, could be gaining in popularity on a more permanent basis. But it really depends on your ability to access things, right? I can speak till I'm blue in the face about great hedge funds and all that, but if I'm only trying to invest $25,000 or $10,000, I'm not going to get access to these hedge funds, right? So it becomes kind of more of an academic exercise at that point.
I think in Asia, we also need to depend on more people like Matthew to produce more graduates and get people into the workforce who understand what alternative investments are, because you go out and have a chat with your banker friends, and how many of them would understand what alternative investments entail, or pick a few products for you to consider in alternatives. So the workforce in Asia, I think, is still rather young in terms of alternatives.
Is the younger generation more open to alternative? Because many would view the traditional as beyond reach already, with too many established players, the giants in there. It's very hard to try and find any wiggle room to work your way into that space. Whereas alternatives, well, it's open, right?
Are you talking about it from an investing or an employment standpoint?
Well, actually both. Let's take the perspective of both, because employment is one of the things that is important to consider given the changes that have been reshaping everything in this world.
Yeah, of course. I think in my experience out here so far, and working with the students that I've been privileged to teach, I think the investing side, I think people are absolutely open. Younger people are absolutely open to different kinds of investing. I think crypto and NFTs certainly had a lot of attention from the younger generations and the older, but certainly in the younger. And then also, don't underestimate this thing about streetwear and the Swee Yong said before, that can be handbags probably as well. My son, who's 22, has done quite a bit of this. He's in Discord groups. He goes to the mall. He builds relationship with the sneaker stores and basically tries to go find these things. He'll buy them for $55 and sell them for $125. Boom, it's right there. So you can just kind of do that at that level. And if you like it, it becomes, look, the best things wind up being passion projects, right? It's like, I like it, and so I want to learn more about it, and then I do it, and I maybe am more successful at making money. So same thing you could probably say with other forms of collectibles like wine and whiskey as well. Now, from an employment standpoint, I think there are a couple of dynamics here, in my view. One is that on the alternatives side, the new alternative side in particular, there are fewer jobs, right? These are smaller companies relative to the big established companies, and so it can be hard to get those jobs, and then ultimately they may not have the same prestige that the younger generation might be interested in their first job. Um, I think ultimately that too comes down to personal preference. Some of my students have gone into these fields, whether it's crypto or anything else, and many more of them have probably on a percentage basis gone into something a little bit more traditional.
It is good to see that some of them actually started up new companies once they graduate to do social and impact investing, the more altruistic sort of businesses. But then I also see a contradiction that some of them are able to do that because their families are relatively wealthier, but yet they can't get the generation above them to actually invest, because the guys who are 60 years old with the millions in the bank account probably think that this newfangled, what is impact investing? Why are you trying to build a new drainage system in this village, in this third world country? So in Asia, I think we really need a little bit more energy in this area to make things work better.
With the traditional, there's a lot of systemic influence, right? It's controlled, it's managed. Alternatives, well, if you look at what happened with Bitcoin, there was a huge attempt to try and control that. And no idea where it's at now. And will there be a situation where, when an alternative becomes large enough, it gets drawn into the traditional?
Well, I think ultimately what happens is regulators are in the business of kind of playing from the back foot. They have to react. It's very hard for regulators to get in front of a trend. So, yeah, almost by definition, when something becomes more popular, it gathers more capital, more people are working on it, then the regulators are going to necessarily play catch up, right? And so I think we've seen that a few times. Actually, in the U.S., we saw that with hedge funds as well. In the kind of the mid to late 2000s, I believe it was. They started actually asking for different kinds of the regulators asked for different kinds of relationships with the hedge fund, shall we say. And the hedge fund industry had been around for a very long time, but it was only then that the U.S. SEC started to kind of step up and say, no, we actually need you to register and some things like that. So yeah, regulators are definitely in the business of catching up to things that get big enough that they pose real risks to people. And crypto, I think, is a really fascinating case of that.
Yes, it is. Yeah. What are some of the more quirky alternatives that you've seen out there, and which to you is the alternative that has really done very well?
I'll start. I think if cat bonds to me feels quirky, even though it's an $80 billion business, and then so does like trading sneakers. But I think that life settlement funds is a great example, the one I described before. And then there's another one we haven't talked about yet, which is buying royalties and other forms of IP, right? So I think many people might have read these stories of, Taylor Swift sold her catalog, or Bruce Springsteen sold his catalog of songs. And again, it's just this kind of really wild thing where somebody's going to go buy, and there are lots of different ways to monetize intellectual capital like that. You can do it in drugs as well. There are actually public companies. You can buy stocks that do this. So there's Pharma Realty, I think is the name of the company. I mentioned in the book, but that's another one in the US where they do basically pharmaceutical royalties, and then a company called Hypnosis,
Oh, they did the
HIPGNOSIS.
artwork. Yeah,
Yeah, and
album
they're
covers.
listed in the UK, and they do like all the song catalogs. I think that there are lots of different opportunities. Ultimately, for individuals, though, I think the real interesting work is in collectibles, because we can surround ourselves with this every day, and then for many of these, the entry price is small enough that we can actually participate. I don't know. That's my quirky.
How does, I mean, if you're a collector of things, uh, how does it, is it an alternative investment for yourself, on the chance that it might appreciate and you might get more back if you did sell it? Or does it have to become something which more people do, and then as a result, there's a network of people doing the same sort of things that you're collecting before it becomes an alternative investment? How does that work? How does something qualify to become an alternative investment?
That's a fascinating question, because I don't think we have a great, kind of carved in stone answer to that. Ultimately, if you could find, you know, limited edition pens, right? There are people that collect pens, and some of these pens can be very, very valuable. I don't write about that in the book because I haven't found anything written about it,
Oh
right?
no, I can
But
tell you somebody. I was having lunch with a friend of mine, Peter Knip, who was with the World Gourmet Summit. He collected Mont Blanc pens,
mm,
and when he sold it off, he bought his house.
yeah,
Okay,
absolutely. I
so
believe it.
that's how
So,
he
and
made a.
anything that is scarce maybe has some intrinsic value due to the materials, right? But also has some emotional connection. In the US now, people are buying old, if you can find an original like Donkey Kong cassette for an Atari or Nintendo or something like that, people will pay thousands of dollars for an unopened version of this, right? So, as our generation kind of grows, we have nostalgia for the things we grew up with. What makes that an alternative? I think the fact that you actually are viewing it as a way to make money, right? I have a bunch of wine. I don't view it. I'm not thinking of that for investment, right? I think of that for consumption. But other people think of wine for investment. You can go to a couple of different firms here in Singapore and open an account, and they can set up a wine portfolio for you for investment, which is fascinating.
So, if somebody gave you at the right price, would you sell your wine?
Some of it maybe, but actually a lot of it, I want to drink it. That's why I bought it.
Okay.
you know, but if somebody
Okay.
just said, I'll write you a check for, however many thousands of dollars for your wine collection, I'd be like, maybe, but
Okay.
actually the thing that makes it tough, Kanan, is that you've got this issue of like actually finding a trade, right? So who's the other side? How am I going to find somebody to buy it? Right? That's another aspect of this that
Yeah.
it's challenging. And so only some things have kind of made it to that level. And there, when more people get involved in it, becomes easier to buy and sell. And that makes a more of what we would call more liquid market, and it helps everybody with their investments.
So there's a question here about the communities which collect things like pens, wines, cars, watches,
Mm,
and many of these have become alternative investment
yep.
tools, right? So how do you find out where you can transact your stuff? Where you can value it?
Yeah. Well, valuation is another tricky thing.
Hmm.
There are all these issues. But ultimately, look, when I started getting into this, it was just, you got to be curious, right? So you're just Googling stuff, you read a lot. There are, uh, different publications from, like Knight Frank is a property company, but they do a lot in the high net worth segment. And they also talk about collectibles in their magazine that they publish, and so you just have to go out and read. Um, and once you get curious, then it's super easy to get on a mailing list, right? And
Yeah.
just have the email show up. There's actually in the US, there's a fascinating company called alt.co, which is trying to be the hub for all these really, off the run kind of alternative investments. So they're out there. You just have to go you got to go do the work.
Hmm. Before we wrap this up, I wanted to ask your views on the new areas of technology. You've got your chat GPT, you've got your AI, you've got space travel, you've got energy and all kind of stuff. Is it worth focusing in these areas maybe a bit more as alternative investment opportunities?
Swee Yong, you've probably done more
Swee
work
Yong.
there recently than I have.
Yeah, I'm not able to draw a direct link yet as to how they might impact real estate or impact investments. But what I'm fearful right now, when I look through some of the stock market chats, the chat groups that are providing advice, some articles I can see are clearly written by machines. And that's even before GPT, because they've already put out algorithms for you to report on stock news every day. And some are pretty badly concluded. So if you didn't read it seriously enough and there's a stock that jumped 15% overnight, you might then jump in and place an order and buy it. But the stock report was wrong. It's just written by a machine that didn't properly analyze the stock. So we need to pay attention for sure. This is the same as when calculators were being replaced by Excel sheets. So we are in that transition, but and the Excel sheet can suddenly produce lots and lots of financial analysis versus our scientific calculator in the past. But don't jump in yet. Learn about it.
Okay. So it's watch and learn and then jump in if you feel like it down the line, right?
Yeah.
Can I just wrap up with a question for for both of you? What are you personally watching out for in the alternative investment space that you hope will just take off?
Okay. I'll start. So in this book, we had a section in modern alternatives where we talk about future trends. Autonomous vehicles, work from home trends, 3D printing, that's going to be impacting real estate somewhat. Not sure how things will find their feet yet, but there's a culmination of new technologies coming together sort of almost at the same time. And now with the wave of GPT and artificial intelligence, I would say that things have become a little bit more murky, especially post-COVID. And then let me try to do an advertisement for the book that I provided on page 235, 4x4 matrix for real estate fund allocation. And also that both Matt and I actually gave away sort of a free checklist. There's a due diligence checklist for real estate. There's also another ESG and sustainable investing sort of guide that Matt has provided, and that's available from some password after you read the book and get to it. These are worth loads if you have to pay a consultant them to you.
Okay. Well done, Swee Yong. Putting in the shameless plug. I like that.
Yeah,
that
so
frees me to be less commercial and focus on the stuff I'm watching. Look, I think for me, I have two things I'm really focused on. One is kind of the world of sustainability. More and more of what I teach is along those lines. I think it's really important for the planet that we kind of figure some of this stuff out. So I want to see better developed markets for, or standards for how we think about sustainability, how we think about impact. Because once we have that, I think we can make it more broadly available to individuals than to just, through some larger institutional investors. So that's the first one. And the second one, honestly, is crypto. I tend to think that blockchain should have some interesting use cases, but so much of what was built was really just Ponzi is not the right word, but it was basically, people kind of more or less taking advantage of other people. And but I'm watching this because I do believe I'm not a Bitcoin is digital gold kind of guy at all. But and I'm not 100% sure why we need a digital currency. And I don't believe the maximalists who are saying that, the Fed's going to debase all the currency and blah, 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 all that. So that's not me. But I think the underlying technology has a lot of promise. So I do, subscribe to a couple of things and, show up in my inbox every day or once a week to try to see, has anybody really come up with something that I think is a compelling use case? Because that, I think, will take the third wave of crypto and digital assets to a totally different level. So watching out for that.
Okay, great. My thanks to Swee Yong and Matthew Dearth for their inputs, insights, experience in the space of alternative investments. I guess coming from this session, it would be a case of really reading up a lot more, understanding what you might be getting into, whether you want to get into it subsequently, and then just rummaging around in your storeroom or whatever, you might find something that you've got there in its original packaging you have not used that could be valuable, right?
There you go.
Apple Macintosh.
Well, you would have used that. Very hard to find one in its original packaging, I think. But I guess the other thing is also to approach it with a fair amount of cynicism and skepticism, because you really have to work your way around all of that noise to get to the nuggets. Happy investing.
Yes.